Business News, where news for business people.
Good morning. You're watching Daybreak on Bloomberg Quint Live, and I'm Alex Matthew. First, let's look at the headlines this morning. Asian markets start the day trading negative, tracking a weak close on Wall Street, and after China's manufacturing PMI comes in below estimates. Jerome Powell, in his first testimony as U.S. Federal Reserve Chairman, takes a seemingly hawkish stance and hints at 4 rate hikes in 2018. India's economy may grow at a faster pace in the third quarter. A Bloomberg survey pegs GDP growth at 7%. The government asks public sector banks to review all bad loans worth more than 50 crore rupees for fraud. HDFC sets a floor price of 1,824.63 for its qualified institutional placement, which opened on Tuesday and will be considered on prices will be considered on March 5th. Well, let's turn to international markets now, and it ended up being a weak day of trade for the US markets, with all 3 benchmark indices trading with cuts of over a percent each. Investors moved to safe haven assets after Fed Chair Jerome Powell's hawkish statement. Here's Abigail Doolittle with the report on how the US markets fared.
Stocks finished lower in Tuesday's Wall Street session. The Dow, S&P 500, and the Nasdaq all down more than 1%. In fact, closing near session lows. Earlier in the day, stocks had been higher, flipping between gains and losses. And then after the new Federal Reserve Chairman Jay Powell testified before Congress, some are thinking that the testimony was somewhat hawkish. That sent yields higher and in turn stocks lower, as it caused the focus to be put back onto inflation prospects, a repricing of risk, and the idea of valuation of stocks, that perhaps valuation is high here. In any case, there was a sell-off for stocks, and all 11 of the S&P 500 sectors fell at the bottom. Some of those rate-sensitive sectors, such as utilities, real estate, along with telecom, consumer discretionary down too, really being weighed on by Comcast, Disney, and Fox. Of course, Comcast put through a surprise bid for the Sky asset, something that Disney has already made a bid on as part of its bid for some of the Fox assets. So overall, investors not liking the prospect of a potential bidding war there. And tech, while it was one of the sectors that was down the least, it was still down about 1%, being weighed on by lots of the big names, including Facebook, Alphabet, and Microsoft. So all in all, Tuesday's Wall Street session certainly had a risk-off tone. From New York, Abigail Doolittle, Bloomberg News.
Now, the comments that Fed Chair Powell made during his testimony and what was viewed as hawkish, the statements essentially were that he believed that the U.S. economy had strengthened since December, and his reasons are fourfold. He spoke about the improving labor market, data points suggesting an increase in inflation, and also the strength in global markets. And finally, he was talking about a more stable fiscal policy. Economists are viewing this as a sign that there could be 4 rate hikes in the current year. But from Powell to his immediate predecessor, Janet Yellen, who was in conversation with yet another former Federal Reserve Chairman, Ben Bernanke, Yellen says that it's not healthy for monetary policy to be the only game in town. And she says it would be a good sign for the economy to have a contribution from fiscal policy as well. Listen in.
I really think monetary policy should not be, it's not a healthy situation for monetary policy to be the only game in town. And I would like to see a situation in which fiscal policy was in a better position to make a contribution on the kinds of occasions and situations we're talking about. And that's one reason that our current fiscal situation concerns me as much as it does.
Let's look at how the Asian markets are faring. They opened, at least the early risers, opened lower, with the Nikkei and Kospi trading with marginal cuts. They've actually, in fact, increased the sell-off, especially in Japan. You have the Nikkei trading with cuts of as much as 40 basis points. Let's head across live now to Rosalind Chin, who joins us from the Hong Kong studio with more on the Asian markets. Rosalind, how are you reading this?
Well, I think you're right. The sell-off is, in fact, deepening here in Asia. We're seeing the MSCI Asia Pacific now losing about 0.5%, the Nikkei down 0.5%, the Topix losing 0.4%, Kospi also down by about 0.4%. Now, on top of all of those comments which investors have been digesting from Jerome Powell about considering the more hawkish stance taken by the Fed going forwards, they're also digesting some data that's come out here in Asia as well. So we've had Japan, that's had essentially showing factory output falling by more than expected in January, and also retail sales declining in December. In China, we've had manufacturing and non-manufacturing PMI. Both of those numbers missed estimates. They were lower than economists had actually even predicted, which was already lower than the previous months. And the number came in, of course, much lower than the month before, which was January. So for February, the numbers were not great. So bearing in mind, though, there have been seasonal distortions because of the Chinese New Year holiday, and that is what the government is pointing to as the reasons for these numbers. So they're saying that the PMI fell because of this Chinese New Year holiday, and they expect the economy to resume back to sort of more normal, stable operations after the holiday period is over. Of course, we'll just have to see if actually that are just words or whether that will actually happen in March, and we'll see PMI pick up again in March. So the official manufacturing PMI number has in fact advanced every March since it started in 2005. And of course there are other issues, compounding concerns, including US steel tariffs, the general sort of more protectionist stance of the US, and also policy shifts may be coming with the NPC, which will be starting next week in China. Of course, that big meeting of lawmakers in China. So right now, we're seeing the Hang Seng down 1.25%, the Shanghai Composite losing 1.6%. Of course, those two having just come online a few moments ago. And the Straits Times Index losing about 0.1% over in Australia. The ASX 200 down by 0.45% at this point in time. So looking again for more data cues out later in the week. There will be some more data out from China on Thursday as well.
Thanks so much for that, Rosalind. Let's turn to the Indian market now, and Darshan Mehta and Agam Vakil are here as usual to set you up for the day's trade and also to tell you what's happening in the futures and options space. Morning, guys. Darshan, first to you. From what I could see from that screen, a lot of red in the Asian markets, and of course the US markets closed in the red, so negative cues.
Yeah, so the SGX Nifty has actually widened the losses. It was down 50 points, now it's down 66 points. So there is a lot of negative traction that's coming in on the markets. Overall, commodities are also trading weak. Crude is also trading weak. So overall, the entire gamut of, the entire basket, be it commodities or be it equities, everything is trading weak at this point of time. Let's take a look at how the ADRs panned out in trade, and most of them ended with cuts of over 2%. So ICICI, Tata Motors, Vedanta, HDFC Bank all down over 1.5 to 2%. The only exception was Dr. Reddy's and Wipro, and these two have been beaten out. So there could be a little bit of rebound that was seen on these counters. Now, crude for the past 2 days is trading rather weak. Overnight it was down almost 1.5%, and in morning trade again the drop continues. Brent is below the $66 barrel per mark. WTI is below the $63 barrel per mark. So there is definitely negative traction that's happening as far as crude is concerned. Let's take a look at how the LME closed, the commodities on the LME closed, and it was an extremely weak close because copper was down 1.25%, zinc was down 1.25%, nickel was down 0.5%. Aluminium managed to hold on and tin managed to hold on. But if you're looking at what's happening with China currently, the last 4 things on your screen, so you can see copper is down over 1%, zinc is down over 1%, aluminium is down, is flat in trade, and steel has started absolutely flat. So not the best of cues coming in from the commodity space. The precious metals are also trading with a negative bias currently. As far as fund flows are concerned, what are FIs doing, what are DIs doing? FIs continue to sell. They sold in 907 crores. DIs bought in almost 1,050 crores. So on the month-to-date basis, FIs have been heavy sellers, but look at the DI buy. 16,000 crores of net buy has happened by the DIs. Close to $2.5 billion have already flown in by the DIs this time around. The mid caps and small caps were rather weak in trade yesterday. The mid cap was down almost 0.9%, so that was trading weak in trade. The FMCG and IT counters did well. They managed to hold on, so both of them ended with a positive bias. So that was the cue. PSU banks again, weakness continues. It was down almost 4%, led by PNB, and the real estate index saw a drop of almost 1.6% in trade. Overall, the Nifty was down 28 points. It basically what led it down was basically the financials. ICICI Bank, SBI, HDFC and Axis Bank were the main reason, while there was some bit of support that was held in because of Reliance and Infosys that came to the Nifty's rescue, and that is why the Nifty was rather flat in trade, but the Bank Nifty saw significant amount of selling. But Agam, what are the FNOQs indicating?
Well, weakness did seep in because of the financials, as you can see from that chart. That said, we really didn't see too much in terms of the benchmark indices movement. There was consolidation, and open interest did increase for the Nifty, and was the same for the Nifty Bank as well, where we actually saw a decline of as much as 5% in open interest. Moving in, when it comes to the WIX, again, it was largely around the same levels, not too much change considering there was a range-bound movement on the benchmark indices, and there was very little change in the Nifty put-call ratio either, so standing at around 1.42. In terms of changes in open interest for a lot of these options, we've seen more activity in the 10,600 and 700 calls, which saw a lot of writing. There were no stocks which moved in or out of the FNO band, but we are keeping an eye on the Ramco Cements, which saw fresh longs coming in. We also saw fresh longs in Ambuja, or rather shorts coming in Ambuja Cements, because there was some weakness, and several other counters as well which were buzzing in trade. But that's what we have in terms of some stocks. We will be watching out for benchmark indices and where they lead us in today's job trade.
Thanks so much for that, Agam. Let's take a check on the rupee and the bond market now, and Saloni Dhanuka has all the details in those two markets to tell you about. Morning, Saloni.
Good morning, Alex. So the rupee extended losses for the second day yesterday and depreciated by approximately 8 paise to end near 64.87 levels against the dollar. Now remember, the home currency has depreciated over 2% so far this month. Now a modest sell-off in local equities along with rising crude oil prices largely weighed on the home currency. Now all eyes will be on the GDP data for December quarter, which is due today. It is expected to increase to 7% as compared to 6.3% in the previous quarter, according to a Bloomberg survey. Moving on to the bond market, sovereign bonds gained yesterday as the yields on the new 10-year benchmark security dropped 2 basis points to end at 7.67%. Now remember, the 10-year bonds are poised for 7-monthly decline on fears that the central bank will start raising rates sooner than expected. Well, on the global front, the dollar index ended near 3-week high yesterday after new Fed Chair Powell said his outlook for economy has strengthened since December, and the central bank could take more than 3 rate hikes this year to support the global growth. The dollar index jumped as much as 0.7% yesterday, its biggest intraday gain since 2nd Feb. However, it ended 0.6% higher near 90.40 levels. Elsewhere, euro slipped against the dollar after German inflation slowed down for the 3rd straight month in February. And lastly, coming back home, dollar rupee is trading at 64.92 levels against the dollar in the non-deliverable forward market, which indicates a weaker opening for Indian rupee in today's trade, Alex.
Well, you said it, Saloni. All eyes are going to be on the GDP number for the 3rd quarter that releases later today. The economy may have picked up, as Saloni just told you, the pace of growth in the October-December quarter. A rebound in industrial activity along with strength in the services segment is expected to have propped up growth. Ira Dugal sums up all the expectations.
The government releases economic growth data for the 3rd quarter of the current fiscal, that's the December-ended quarter, and the general expectation is that you will get a number which suggests that the economic recovery is gaining pace compared to what we saw in the 2nd quarter. Let's look at the estimates. Bloomberg polls suggest that you will see GVA growth come in at 6.7% in the 3rd quarter compared to 6.1% in the quarter before that. GDP growth is expected at 7% compared to 6.3%. Important to compare it also to the year-ago quarter, because remember, the year-ago quarter is when we had demonetization getting announced, although the big impact of demonetization came in Q4. But in terms of level of activity or level of growth, you are expecting both GVA and GDP growth to return to the same levels that we saw in the 3rd quarter of FY17. Remember, over this 18-odd months, we've seen 2 shocks to the economy. First, demonetization and then GST. And what all economists are watching to see is is whether economic activity rebounds to levels that we had seen before these twin shocks. To gauge that, some of the sectors that are important to track are agriculture, manufacturing and construction. These are also heavy employment sectors, so important to track even from the employment standpoint. On agriculture, not much of a change expected. In fact, there could be a slight decline in growth levels from about 1.7 to about 1.5%, say economists. On construction, though, you are expecting a significant pickup. Construction had remained modest in the second quarter at about 2.6% growth. You are expecting a substantially higher number on construction. Manufacturing was strong last quarter, and the expectation is that that will continue to be strong, and perhaps growth in that segment would move up beyond the 7% that you saw in the second quarter. Those are the three major sectors to track, and those are GVA growth numbers. Apart from that, always important to see the expenditure side trends to try and understand what is happening in the underlying economy. One thing which had raised a glimmer of hope of a pickup in investment activity was the gross fixed capital formation number. That segment had seen growth of 4.7% in the second quarter. In fact, that was a 5-quarter high. People are now watching to see whether gross fixed capital formation continues to rise, and if so, is that a signal that there is at least a modest rebound in investment activity. Private consumption expenditure on the flip side was slightly weakish, not an outlier, but at 6.5% growth was slightly weaker than expected in the private consumption expenditure segment. But nobody really sees much or significant weakness in private consumption, at least not based on other high frequency indicators. So perhaps that one will be steady as it goes. The final one to watch is government spending. Last quarter, you had seen government spending growth come down quite sharply, although there was base built into it as well. Remember, the second half of the year, the government's own finances have not been in the best condition. So some of the segments which get a boost from government spending may be weakish, and you may see government spending not accelerate as much as it has in some quarters in the past year to 18 months or so. The importance of the Q3 numbers is to the extent that it should fit into the full year growth estimates. The RBI now expects full year FY18 growth at about 6.6%. So you're basically going to retrofit that Q3 number to ensure that we are on track at least to meet that 6.6 number, or if we are on track to better that 6.6 number, because from here on, what everyone is watching to see is what growth recovers to in FY19. The RBI expects a pickup to about 7.2%, but any underlying trends in all of these data will help us solidify the forecast for the next fiscal year as well.
Well, we know soon enough what those numbers turn out to be, but that's everything that you need to know in the run-up to the announcement of the GDP numbers. But let's shift focus now to the commodities market, and Jayesh Khilnani has all the updates there. Jayesh, Darshan in his trade setup essentially talked about weaker oil prices. What's happening there?
That's right, Alex. So, oil prices are currently trading 0.5% lower after falling about 1.5% overnight. Now, why is this so? Is because of the inventory data that is likely to come out tonight. So the overall crude inventory is likely to build up 9.3 million barrels, lakh barrels for last week, and the gasoline inventory is also likely to build up for a fourth consecutive week. So that is not going down well with the oil markets, and that's the reason we are seeing a downfall in the oil prices. Moving on to the base metal space, the index itself closed about 0.7% in the red. As far as individual base metals are concerned, aluminium and tin were the only gainers that we had. So aluminium actually snapped its three-day losing streak on account of the aluminium cancelled warrants that rose about 5.8%. While copper and zinc declined more than 1% each. Nickel and lead closed marginally lower. Now, if you look at the Shanghai Futures Exchange, most of these base metals have started on a negative note, with zinc declining more than 1% for itself. As far as gold prices are concerned, we saw a 1% dip for gold prices and have now slipped below the 1320 per ounce mark. Now, this is on the back of Fed chair comments which hinted at more than 3 rate hikes this year. That actually boosted the dollar, and it actually rose for the second straight day. Did not go down well with the commodity space.
Right. Thanks, Jayesh, for that. Now, let's move on to another big story that happened over the course of last evening. In the wake of incidents of fraud in the banking sector, the Finance Ministry has asked the public sector banks to identify fraud and suggest ways to strengthen operations within 15 days. Nico Jori filed this report on the move and its likely implications.
MDs of public sector banks have been asked to detect bank frauds, consequential cases of willful defaults on time, and refer all these cases to investigating agency CBI. The Financial Services Secretary, Mr. Rajiv Kumar, tweeted, MDs have been asked to examine all NPA accounts exceeding rupees 50 crore for any possible fraud and involve investigating agencies like DRI and ED in cases of FEMA or PMLA violations. Chief Vigilance Officers of public sector banks will vet complaints and coordinate with CBI for frauds that exceed rupees 50 crore rupees. The Financial Services Secretary tweeted earlier in the day, the Finance Ministry had given state-owned banks a 15-day deadline to identify weaknesses and operational and technological risks in the banking system and take preemptive action. A group of executive directors and a chief technological officer will be constituted, which would make a comparative assessment of the operational risk management practices with the best in industry standards.
Well, we also spoke to H.R. Khan, who is the former deputy governor of the Reserve Bank of India, about the latest move, and here's what he had to say.
Coming to this issue of referring every case to CBI and all that, I think one has to look at the capacity and limitations of CBI in terms of handling so many cases. And the best way is to, of course, we should get information about borrowers from CBIC. But the best way is to pick up some high-profile cases, take them to logical end in a time-bound manner, and give exemplary punishment to the fraudsters, so that the people draw lessons from that. And it will be unwise to spread the thin resources across so many cases and not reach any logical conclusion. So I think that may not be the right way. The best way is to pick up high-profile cases and fix time frame and take them to the logical end.
All right, that's a view coming in from H.R. Khan. But let's move on. And HDFC, or Housing Development Finance Corporation's qualified institutional placement opened yesterday. That's part of its 13,000 crore rupee plan to mop up funds to invest in its banking and other subsidiaries. The floor price for the QIP has been set at 1,824.63 rupees per share. That's only slightly below the market price at close yesterday. The mortgage lender has said that it will consider, its board or executive committee will consider and determine the issue price on the 5th of March. The government has notified the methodology for commercial coal mining. The policy, which will open up the coal mining for private players, aims to follow an ascending bidding process, which in other words translates to the highest bidder winning the contract. While the miner will decide on the amount of coal that's going to be mined, it cannot fall below 50% of the amount committed for production each year. Now, Shraddha Babla joins in with the stocks in news. Shraddha, what are the stocks that are likely to be at the center of action today?
Morning, Alex. Starting off with Cipla, which has signed a distribution pack with Roche Pharma India. This is for two drugs, which I cannot pronounce. So Cipla will be in focus. You have DLF, which said that its subsidiary has emerged as the highest bidder for 11.6 acre Gurugram land in, for about 1,500 crores. L&T Infotech will be another one which will be in focus. They've said that the promoter Larsen & Toubro will sell up to 2% stake in the company, and that will be to achieve a minimum public shareholding. Now, L&T held about 83.7% stake in L&T Infotech as of 31st December. You also have some clarification coming in from ICICI Bank. They've said that they do not have any exposure to Nirav Modi group of companies, but they have said that they are a working capital lender to the Gitanjali group of companies, and that is along with several other banks in the consortium, and that their exposure at least is not the highest as compared to the lenders in the consortium. You also have Sadbhav Infra Project, which has emerged as the lowest bidder for a NHAI project in Gujarat with a bid price of 1,048 crores. And finally, you have a Bloomberg Quint exclusive. Dalmia Bharat Consortium is poised to win the race for Binani Cement, and Dalmia Bharat Consortium had made a bid for about 6,350 crores for the debt-laden Binani Cement, and Dalmia Bharat had made that bid along with India Resurgence Fund, which is backed by Bain Capital and Piramal. So again, Binani Holdings and Dalmia Bharat to watch out for.
Well, Shraddha, I've spent the last 30 seconds trying to pronounce these names to myself, and I don't think I'm doing much better than you. But thanks so much for that. Let's turn to the big brokerage calls of the day, and Somit Sarkar has all the details for you there. Morning, Somit.
Good morning, Alex. And the big brokerage call for the day, we have Motilal Oswal on UPL. Now, the brokerage has initiated coverage on the stock with a buy rating and a target price of 945, which suggests a return potential of close to 31%. Now, according to the brokerage, UPL is in a sweet spot to grab impending opportunity in generics market. Now, products worth $3 billion are going off patent, which is a big opportunity for UPL according to the brokerage. Now, generic pesticides backward integration will drive the profitability for the company, while new launches and branded products would drive the growth for the company going forward. Now, the brokerage is expecting robust growth across all geographies from UPL. Now, UPL is in fact expected to outperform the industry growth rate in all major markets. Now, it is expecting companies' EBITDA margin to expand on better product mix and operating efficiencies, while it is expecting the company's revenue and EBITDA to grow, net profit to grow at a compounded annual growth rate of 12% and 14% over FY18 to FY20. The brokerage is also expecting strong free cash flow generation, which would improve the company's balance sheet, and it is expecting the return ratios of the company to remain healthy. Lastly, it also has a bull case target price of close to 1,213 rupees, which suggests a return potential of close to 68% on UPL.
Thanks, Somit. Now, former SBI Chairman Arundhati Bhattacharya believes that the new bad loan reforms are certain to cause short-term pain, but it is what they aspired for in the long term. Speaking to Bloomberg, Bhattacharya said that we are nearing the end of the NPA cycle. Here's a slice of that conversation.
We are about to see the end of the cycle. And if you look at the bankruptcy code that this new government has brought in and has been able to operationalize, and the number of cases that are now going there, some of the largest cases are now on the verge of getting resolution. So I think, the pace there is picking up, and that is something that's very welcome.
What about the tightening norms for the recognition of some of those loans? Is that making any difference at all?
I think, the tightening norms have just come in. Of course, the tightening norms will cause some amount of pain in the short term. In the longer term, it's something that we all aspired for, but it was difficult to achieve, given the fact, the system itself isn't organized in that manner. But now that the norms have come in, I am sure that industry as well as the banks will all benefit from it ultimately.
The Modi government recently announced a major recapitalization. I'm looking at some of the details as we speak for the banks there. And this is specifically for government-owned banks, isn't it?
Yes.
Is that going to be enough, though? Or is there more needed from the government?
See, at this point of time, they have done a proper deep dive into the bad loan issues to determine how much capital is really going to be required. However, they have forecast a certain amount of growth rate. I don't think they have taken a growth rate that is beyond 12% for these banks. And therefore, it all depends upon how the banks grow as to whether the capital will be sufficient for both regulatory as well as for growth. For regulatory requirements, it will be sufficient. We are 100% certain of that. How much it will also help growth is something that we have to see as we go along.
Well, there's lots that's happening globally. You have the monetary policy in the US and its implications on markets globally. You have the GDP growth numbers for the third quarter that will come out later today for India, and a lot more to talk about in the markets, the live markets over the course of the day. And you'll find all of that on Bloomberg Quint Live. But there are also several stories on the website. That's bloombergquint.com, so do log on. These are just a couple. More than 24 banks have decided to seek a forensic audit to establish if Mehul Choksi-led Gitanjali Gems Limited indulged in fraud or not. This is in the PNB fraud case, of course. Nearly 165 public shareholders of Rico India, owning a combined stake of 2.3%, filed a petition at the Mumbai bench of the National Company Law Tribunal seeking relief, accusing Rico of oppression and mismanagement. Well, that's all we have time for on this edition of Daybreak, but all you need to know is up next, so do stay tuned. Thanks for watching. This is Bloomberg Quint.